It is Wednesday, March 25th, 2020. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we will pass over some of them quickly but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing in the charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes. This month, I'd like to springboard from last month's Under the Lens, which discussed the coming era of stagflation, and our recently released video with Charles Hugh Smith on the corona carnage and the coming of helicopter money. As such, I'd like to discuss the areas highlighted here. Let's start with an understanding that we must separate our thinking on the global pandemic, which we're currently in the brutal throes of, versus the historic drop in the global financial markets, which we've been experiencing in parallel. Obviously, they're linked, but we need to view one as a shock, which will inevitably come under control. On the other hand, the other has every indications of being the beginnings of something much more profound. The latter, investors must understand and now think about positioning for. Why differentiate? The financial markets were already nearing a long overdue and inevitable business cycle recession, a business cycle that through monetary policy had created profound global imbalances, debt and leverage levels to historic degrees. The coronavirus only destabilized this already fragile, brittle, and top-heavy system. Focusing on only the pandemic may lull investors into seeing that things will soon quickly get back to normal. This is highly unlikely to be the case. Violent corrective regressions to the mean as bear market counter rallies? Yes, highly likely. What is centrally important, which we will discuss, is the policy responses to all this. It was poor policy responses to the 1929 market crash that led to the harsh depression experienced in the 1930s. It is eerie how similar many of the underlying issues are today. It is the expected policy regime change that is most profound for investors. I was a youngster in the 1950s and witnessed firsthand the ravages and fear of polio, shown at the bottom of the pink box. It was truly frightening. My grandparents talked about the Spanish flu that they had witnessed in 1918. The Spanish flu lasted 2 years from January 1918 to December 1920. It infected 500 million people, about a quarter of the world's population at the time, and killed 12,000 Americans. Though exhibiting completely different characteristics, they both lasted multiple years and came in waves. Those that were infected either died or developed immunity. Polio vaccines and school-wide vaccinations eventually harnessed polio. Both took time to kill and for societies to get over the shock. You've all seen this flattening of the curve model that is used to help us to understand the need for social distancing and sheltering in place. It is solely about containment within the capabilities of our hospital system's capacity. It isn't about duration and total impact. The only benchmarks are China, which has reputedly flattened after 3 months, and the still exploding countries of Italy, Spain, and Iran. The jury is still out. My macro analytics co-host, Charles Hugh Smith, put this illustration together at the end of January, before the White House and media narrative took control. His research said we had a long ways to go. I marked an X on his original work to illustrate where we are likely now. Here's my view on this. Thanks to incredible actions by all levels of government and our healthcare professionals, we're likely to contain the virus to the degree of not seeing wholesale code blacks at U.S. hospitals. We are also likely going to soon see therapeutics to counteract the virus. I also see a vaccine being broadly available within less than 12 months as we bring the best minds and technology globally to bear. What I also see, though, is the pressure to get the economy moving again as we hurriedly remove shelter-in-place, travel restrictions, social gathering sizes, etc., in an attempt to get back to normal before the coronavirus triggers a greater depression. This will mean we'll likely experience and can then expect smaller disruptive waves to occur. We will likely see them anyway, irrelevant of just even how quickly we take these restrictions out of place, because this is a global problem. Fear is not going to go away quickly. Confidence comes back slowly once the damage is done. Our society is going to change in the near term in ways we don't yet fully appreciate, from how we gather, do business, travel, dine, etc. We have experienced a social shock that will act as a headwind to getting back to normal. This will be like pressure on the brake pedal of the economy as we try and apply the accelerator. We truly won't know for a while how heavy the brake pressure will be. Let's now switch to the market crash by comparing this one with prior ones. This is historic, obviously, by any measure. So far, it has dropped the furthest in the fastest period of time, comparable only to 1929 and 1987. No other market drop of this degree has not been the kickoff to a multi-year bear market, resulting in even lower lows. Knowing the extreme conditions we entered this sell-off under, it is hard to argue this would be anything other than the beginnings of such a period. The degree of market volatility and extraordinary actions the Federal Reserve has already been forced to take suggests we can conclude nothing less. Of course, we are going to see violent counter-rallies. They are the hallmark of bear markets. Sentiment and behavioral reactions change slowly. Prior to the market crash, I showed charts of how well we were tracking to 1929, 2000 Y2K, and the 2008 NASDAQ. We mirrored their timing tops and precipitous drops to an eerie T. Here is a 1929 Dow comparison. History suggests a major bounce followed by relentless pain, and I'll talk in a moment about why we'll likely see this initial major bounce here. In my estimation, we've experienced a perfect storm. A global shock in both demand and supply, an unexpected oil war initiated by the Saudis, which is creating a shock to the high-yield credit markets, monetary stimulus showing itself as ineffective and insufficient, volatility higher than the fall of 2018's VIX, which again is removing the perceptions of a Fed put, and markets no longer following the global liquidity proxy. The acknowledged accelerant catalyst for this crisis is the coronavirus or COVID-19 and its unexpected demand and supply shock. Both shocks together are unprecedented and certainly not seen on a global basis since World War II. The critical crack that initially is being exposed is what we warned about in prior videos, and that is collateral adequacy, or more accurately, inadequacy, stemming from extreme debt and its distorted supporting leverage levels. The critical tipping point here, in my estimation, on a longer-term impact basis, will be a shift to fiscal policy or helicopter money from and because of monetary ineffectiveness. This can be considered as a regime change. What is presently occurring is repricing of risk, that is in the credit markets, pricing in a recession, we're seeing that in PE multiples, repricing of earnings, that is earnings per share, and yet to reprice, or will soon, corporate buybacks and dividends as they begin to shift. And we're beginning, as I said, to see this. It's going to be dramatic because of cash flow limitations and frankly even some bailout restrictions from the federal government for those corporations desperate for cash and have already drawn down their credit lines. Before the crash, the yield curves were pretty clear about what lay ahead. A recession was long overdue. When the new numbers are available, this chart will be in the red, and the red band will have appeared. This is a chart you need to pay the most attention to. The top panel is the 10-year U.S. Treasury versus the Fed funds rate spread. The middle panel is the S&P 500, and the bottom panel is MATA's proprietary momentum indicator. What this chart fundamentally tells us is the yellow area precedes major bear markets. In the yellow area, we experience two inversions in the yield curve. It is only after the second inversion and the steepening of the yield curve that we see a sustained drop in the markets, shown in pink. We should expect to soon see the yield curve steepen, and when it goes positive, for the markets to then start a steady recessionary adjustment. In the meantime, markets are likely to counter-rally while the yield curve heads higher, and we see various fiscal and monetary policy reactions, and likely starting to see some positive signs concerning the coronavirus becoming somewhat under control. The questions at hand are these. Are we in a recession? Is this going to be a global recession? What are the probabilities we're going to experience a depression era? The definitive answer to these questions presently hinges on two pillars. First, when will the daily growth of new cases begin to slow? At that point, the markets will be able to better price the resulting damage. Presently, the problem is seen to be 6 weeks to 2 months before we start getting back to normal. It appears that statistically, by the third week of the shutdown, the numbers will give us the first clear answer. We're about halfway through that window in the U.S. So sometime closer to April 3rd, with the March employment numbers coming out, the markets will be able to start better pricing in the real damage. Secondly, when and what the fiscal bailout policies will be that come out of the U.S. Congress and the EU. As we go to press, we've already seen Phase 3 announced and the size of it. But what will their size be in total? How will they be targeted, and how rapidly can they actually be implemented? We'll see more changes and more announcements as we're finding they're not doing the full job that we expected. There's a big difference between the financial markets and the real economy. It takes a long time for things to work into the real economy. And frankly, a lot of the actions we've been taking for years did not impact the real economy. Clearly, the current fiscal policy's attempts are to get money to the public, but how will they spend it? What will determine how they will spend it? Volatility will go with both as the numbers are digested. The U.S. will no doubt react, but will the EU? And how fast one without the other is the major tell to watch for. I'm very skeptical about the EU, and it is just as critical. The damage that has already been done to the global economies is unprecedented and not yet fully understood. To estimate a ballpark figure, we should look at gross output. Unlike GDP, which captures final sales value, the GO, if I can call it, includes the payments between production stages. The effect of the last credit crisis in 2008 and 2009 was significant, knocking about $4 trillion off the total. This time with the added burden of widespread supply chain payment failures. Globally, it's obvious this will be far larger. We can only guess what a national shutdown will do. If, as in Italy and France, Americans end up only being able to buy pharmaceuticals and food, which appears to be the state we're at, that would preserve only 8% of the goal. Payment failures will therefore be a significant part of the $36 trillion of the gross output statistic. Therefore, fiscal policies must somehow offset this, or we'll see a very deep recession or worse. The U.S. is already, as I said, in Phase 3 of its fiscal policy initiatives, and it's not nearly enough yet. Not only are all goods, but services being affected as well. The supply chains are not as simple as the term might suggest, with one-dimensional series of inputs leading to a final product. Inputs from many other sources are required in each step of the way. It is exaggeration to say that the interconnectedness of all these processes accounts for nearly all of private sector go. That major payment failures continue to have an impact is seen in the enhanced levels of repo facilities daily extended by the Fed. It can only continue to escalate from here. However, the real damage is likely in the tail risk of the change in risk tolerance and fiscal policies, which are ushering in an era of currency debasement and monetization. Over 37 million jobs in the U.S. alone are vulnerable to short-term layoffs. What it is globally, no one knows yet. While economists wait to evaluate how severe the downturn could be, a bleak new report published by Moody's Analytics found that more than half of the estimated 153 million jobs in the U.S. are at high or moderate risk. Not all of those jobs will be lost, but it's possible that as many as 10 million workers could see some impact on their paychecks via layoffs, furloughs, fewer hours, or wage cuts, according to Moody's Analytics. Moody Analytics also projects that at least 27 million of those 80 million jobs are at high risk as a result of the virus outbreak. Most of the at-risk jobs are concentrated obviously in the transportation, travel, leisure, hospitality, and temporary help services, and oil drilling and extraction industries. The other 52 million jobs at moderate risk include positions in industries such as construction, manufacturing, motion pictures, wholesale trade, retail, and private education services. And with shelter in place now in place, they're all being dramatically impacted. And how many are actually going to have to take out unemployment, we don't know. Goldman Sachs estimate that jobless claims surged to 2.25 million during the week ending March 21st, blowing past the previous record of 695,000 set in 1982. Bank of America reports that jobless claims will spike to 3 million next week as the coronavirus chaos widens. We'll see, and you'll see this by the time you probably listen to this video. Fed Governor Bullard is reporting he can see 30% of all American jobs being impacted. No wonder Trump seems scared of what this is going to mean to the economy if he doesn't get people back to work. The Goldman Sachs economics team has issued a shocking economic forecast predicting a 24% plunge in second quarter annualized growth. Morgan Stanley joined Goldman and JP Morgan in predicting a depressionary crash, expecting Q2 GDP to plunge 30%. Again, everyone is guessing, but the numbers suggest at least 2 quarters of negative growth, which says the U.S. is already in a recession and likely the world. We saw 25% unemployment during the 1930s depression. We are likely not going to see that level of sustained unemployment, but could see a deep and protracted downturn if these numbers globally don't experience a major and rapid rebound. There is little doubt that corporate profits are going to see a massive hit. Many corporations are already signaling cash problems, dividend cuts, and emergency drawdowns of credit facilities, which are placing tremendous pressures on banks' ability to support them. We'll talk in a moment about buybacks and dividends, which have been the primary supporter of equity markets for nearly 5 years now. Credit and credit protection costs have shot up. Credit ratings have been taken down, and areas such as leveraged loan and collateralized loan obligations are presently impaired. The Fed is working overtime to fix the plumbing here, but the damage has already been done. The Bank of International Settlements reports that 15 to 20% of global corporations are already zombie corporations prior to this crisis. These are corporations that cannot meet their debt interest obligations without borrowing. This is where the problem will soon be the worst, and may be the cornerstone of whether we see a depression or just a very hard recession. I haven't time to go into all the issues currently at hand that need attention. Suffice it to say, we're going to experience change in expectations, risk tolerance, collateral values, and much more as the answers to our 2 pillars unfold. Like the other factors, there is still no way of knowing the magnitude of many of them. What is clearly knowable today is that we're going through a major regime change. We are moving from the dominance of monetary policy to that of fiscal policy. This may sound like nitpicking for ideologues, but it isn't. Monetary policy has pushed its limits of effectiveness, and it is now going to take massive fiscal spending to stimulate economic activity and keep the economy afloat. We are well advanced in a historically proven fiat currency cycle, which has never ended but in one and only one way, with a collapse. What we need to appreciate is that over the next few months, we can expect transition from the gluttony stage where the governments create money and credit at will through monetary policy to abuse, where government through fiscal policies monetize debt and prints fiat money to fund obligations and guarantee the system. The next stage is shown here, where lost confidence becomes rampant and with it falling investment stagflation. Economic stagflation and everything that comes with it lies ahead, whether it is protracted recession or the dreaded D word. We have talked about this in terms of the quantity theory of money and the forced road by governments to nationalization prior videos, so I won't go further into that discussion here. What we haven't discussed previously is the form that the fiscal policy or helicopter money will take. No longer is too big to fail politically acceptable. Fiscal policy is about politics. Even though fiscal policy must be aimed at highly productive usage, it is likely to fall short in this regard. It will take the form of QE for the people, or putting cash directly in the hands of the public without payment, gratis. Politicians have always taken the most expeditious route, not the difficult and needed route. They are like those children that cheat on their exams and homework. Their prime goal is not to be blamed, get reelected, and understand that perception is reality in politics. Corporations will face tight rules regarding the repayment of what will be loans. No layoffs, no buybacks, no dividends, no executive bonuses, etc. Corporations have come to expect to be bailed out instead of suffering the consequences of bad and risky decisions with shareholder money. They'll somehow be too big to be allowed to fail. Money desperately needed by corporations will be hidden deep in the bills, with the bills being given names centered on the public's outcry. The problem will likely be too little too late and ineffective delivery. The public will be forced to use the money to pay overextended credit and not be available for economic stimulus, which it was intended for. The catch-22 is that free money is effectively currency debasement and monetization. This will accelerate the fiat currency failure cycle I have showed many times, and with it, hyperinflation, which is first and foremost a currency event and driven by debasement of the currency. The roadmap ahead is going to be increasingly about currencies and an accelerating erosion of the standard of living in developed economies. Buybacks and dividends are going to fall dramatically despite stocks being even cheaper than they were. Corporations will be hoarding limited cash. Government loans and assistance will likely prohibit them. What is going to take the place of the $4.5 trillion in buybacks that have been flowing into buybacks over the last 5 years? Stocks should be expected to fall precipitously. Obviously, this cannot be allowed to happen, and the Federal Reserve will, like Japan and Switzerland, soon be buying or guaranteeing stock values. The Federal Reserve will have no choice. They are trapped. Like Zimbabwe and Venezuela and other countries that debase their currency, stocks will likely head higher based on the debased value of their denominated currency, an illusion of prosperity where it takes more worthless money to buy the same asset. We are on the road to hyperinflation sometime in the next few years, if not sooner. Inflation and slow economic growth will deliver stagflation. Currency debasement and global de-dollarization will steadily lead to hyperinflation and fiat currency failures. As things continue to deteriorate, we will witness more and more nationalization. Oh yeah, it will be given various politically acceptable names like conservatorship or subsidized like China's state-controlled enterprises. This is the roadmap we are now locked into. And we are only in the early stages from a coronavirus perspective. The real economy is behind that. It is tough to imagine that the financial markets could yet have fully priced the resulting damage in U.S. and global markets, especially considering we have 1.7 million in the world under quarantine and India about to make it 3 billion. We have just witnessed global stock and bond markets lose 25 trillion in paper wealth in a matter of weeks. This is a profound shock to a fragile, brittle, and unbalanced economic system that the reactive, expedient printing of 4 trillion is not about to quickly fix. Yes, we're still in the unknowable acceleration stage. So in closing, as I always remind you, remember the answer will be to print more money. It is the only answer politicians will ever agree on, and we're seeing that today. That is, until no one wants it or trusts it. Invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2020 turn out to be an outstanding investment year for you and your family. I thank you very much for listening.